Howdy there, folks. Welcome into today's video. It's a 5-piece here today. 5 videos up for me to react to. First one, we got to talk about Palantir. So Snowflake, it's a complete disaster. That stock's been down anywhere from 17 to 22% today. Palantir is doing something pretty unbelievable. I want to explain what's going on there. Then we'll talk about Snowflake if there's an opportunity there and those sorts of things, okay? From there, we're going to get into some data that was released this morning in regards to inflation. Very important. We're going to hear the Celsius CEOs talk a little bit here. I know a lot of you guys are interested in Celsius stock, or maybe you own the stock. Company's been absolutely exploding for the last 3 to 5 years. It's unbelievable what they've pulled off. And so thought we'd go ahead and get into that stock in this video. Then we're going to talk Apple. This is actually from a little over a day ago, this video. I've been wanting to react to this one. Apple needs to do something big. Rivian might be the answer. Is Gene Munster about to say Apple needs to buy out Rivian? That should be interesting. And in this one, I've been wanting to do this one for days. This one is over 3 days old now, but I've been wanting to react to this one with you guys. JP Morgan CEO Jamie Dimon on the state of the U.S. economy. So I thought that would, the biggest banker, the big dog of them all, thought we'd go ahead and react to that one here today, okay? Appreciate y'all joining me as always. Thanks so much for being here. I'll ask in return, smash a like, hit that subscribe button. I'm not 100%, I can tell you that much today, but I'm good enough to record this video, and I don't want to keep pushing off this video forever. I'm taking care of my kids today, and all 3 of them. And let me just tell you, because my wife's really under the weather. I'm like a little under the weather. My wife's super under the weather, so I had to do school with my kids today because my kids are homeschooled, right? So you'd get a kick out of the math problems I have my 9-year-old doing, and stuff like, okay, if you owned a home and you rented out to a family and the rent you got was $2,600 and you had this bill and this mortgage and this, what would your profit be? Questions like that. If you had $15,000 invested in Apple stock and the stock went up 50%, how much would your profit be? It's typical stuff you would expect from me if I'm your teacher. Let's just put it that way, guys. Appreciate you joining me as always. Got a free workshop for you guys also. That's pinned comment down there. How much money do you need to retire? Is a very in-depth video there. I think you guys will enjoy that one quite a bit. So in regards to Palantir, before we get into Snowflake here, this is massive, folks. Absolutely massive. Do you know what's so massive about this? Look it. Palantir is having a dang good day here today. It's 2.7% up. It's my 3rd best stock I personally own here today, right? And that's pretty shocking. And the reason that's so shocking is Palantir and Snowflake used to kind of be joined by the hip. I always told you guys I did not think that was correct. Snowflake's business model and Palantir's business model are different. They should not be grouped in the same, in my personal opinion, but they've always gotten grouped. Snowflake, I would say, is much more, the TAM for Snowflake might be bigger, but with that being said, a company like a Snowflake is much more, I would say, I don't want to say it's a commoditized product, but I just think there's a lot more competition. A Palantir might be a little less TAM, but a Palantir is a very specific product, and I think Palantir is near impossible to compete with. So there's always been a big difference. And so the fact that a Snowflake could be crashing here today, and a stock like Palantir is having a very nice green day when Snowflake's crashing is definitely good news. And the fact that Snowflake's now talking about revenue growth of in the 20s this upcoming year, that's crazy. Because guess what? Palantir is going to likely have revenue growth in the 20% somewhere in there this year, unless they blow it out of the ballpark and do something in the 30s or 40s or something, but is expected to be in the 20s. This is crazy because it wasn't that long ago, the thought process around Snowflake was, oh, Snowflake has so much growth compared to Palantir. Like, just go back in time 2 or 3 years ago. That was a talk. Snowflake has so much growth. Look at how weak Palantir's growth is compared to Snowflake. Snowflake's outgrown them 3x, 4x, 5x a quarter in terms of revenue. And now look at, now we're talking about these companies could actually, their growth rates could be very similar this year. It's crazy how fast things change, and that's where really studying up on these businesses and understanding them on the highest level possible can definitely help immensely. Okay, let's get into this.
You see almost 19%. This after the company's outlook, its guidance for the next fiscal year was well below what many analysts at least expect. Also, the announcement that Frank Slootman, its CEO, is retiring, that also pressuring the shares. Salesforce beat estimates, but perhaps as well the guidance for 2025, giving some investors pause. You can see stock's not doing much of anything right now. Brent Thill is the Jefferies tech analyst, covers both, has buy ratings on both. And, well, let's just start with Snowflake. Brent, what was your take? How unexpected was this? Clearly, I guess, to answer my own question, fairly unexpected that they would come in with that lower growth rate for next year.
Yeah, good morning, David. It was definitely lower. The street was looking for 30% growth. They guided to low 20s. Part of this, you could believe that they put a new CEO in, and you would not want to set a high bar for a brand new CEO coming in.
True.
So that was obviously disappointing. But behind the scenes, they had really strong backlog acceleration.
But the problem is, let's say, they talking about low 20s% growth. So how much are they sandbagging? So maybe they report high 20s revenue growth. Well, shoot. Palantir might be high 20s revenue growth this year, right? I mean, that's
signed their largest deal ever at $250 million on a 5-year deal. So they're showing great strength and underlying momentum. I think part of this downfall is related to Slootman resigning. Effectively, Frank and Mike Scarpelli were the two co-pilots everyone bet on for many years, right? They sold their first company. They went to ServiceNow pre-IPO, took it public, established the company, grew that to $100 billion plus market cap with Bill McDermott's leadership. And so this is a big blow for shareholders that really believed in these two co-pilots that had flown for a while for many, many years. And given.
And look at that performance for Snowflake, 21% in the past year. That's really, really poor performance, folks. I mean, really poor performance. Let's pull up Palantir's 1-year performance here. Palantir's 1-year performance, 219 flipping flapjacking percent. That's incredible, right? You look at a stock like Meta, 180% 1 year. Shopify, 87%, right? I mean, that's incredible. So, you look at somebody like, Snowflake here, and that stock is just underperforming significantly. Many other tech companies out there, 21% in this past year, 21% usually is fine. But not if you got other stocks out there going up 50%, 100%. One of your supposed peers, Palantir's up 200. Palantir's 10x. Snowflake, that's incredible.
Amazing returns to shareholders. Yeah. So I think part of this is a Slootman effect. Part of this is just a conservative guide in front of a new CEO. And if I was the CFO of Snowflake, I wouldn't set a high bar for the new CEO coming in.
Right.
So we don't think this is competitive.
It makes it much easier for him to exceed expectations, I guess is your point, the new CEO. I do wonder as well, does it take into account any of the new products conceivably the company will be introducing over the next year?
No, it does not. None of the new AI products are in the mix. So effectively, I think this is the bigger issue for a lot of these software names. If you look at the semi names, NVIDIA and AMD are up again. I've been traveling through Europe, meeting with investors, and no one wants to get out the semi trade. Effectively, many of these AI products, it's hype, and it's not revenue reality today. For every software company, it's low single-digit % of revenue. So investors have gotten a little bit over their ski tips as it relates to the excitement of AI. It's going to come, and we've been saying this, you have to be patient, but it's not here yet, and the revenue is not going to be material until the end of 24 into 25. So I think right now you have a semi cycle that's working. All of our companies in software and internet are buying semis. They're getting ready for the AI wave. Expectations that this spills and creates immediate revenue are false. That's not happening. And so right now we believe, again, you want to be positioned in a lot of these names on weakness. Every single software company I cover has set numbers below that of the street. And I think it's a common pattern. So this isn't new for Snowflake. Everyone is doing this. Even Salesforce lowered guidance below the street for the year. And again, this is because you don't have a big product cycle on AI yet that's material to revenue. It's hype today.
Well, yeah, you mentioned Salesforce. Let's just end on that. Again, the stock's sort of flat on the day. The margin improvement continues, though, and that seems to have been what's caught
numbers were good from
the
Salesforce.
Sort of imagination
really
of investors over the last year.
Absolutely. Margins have been first for Mark Benioff. They've done a nice job driving from 20 to low 30s. They still have a long way to go. We've said this, that cruise altitude from 30 going up to high 30s is very easy. If you look at all their peers, Adobe mid 40s, Oracle low 40s, everyone is above Salesforce in their peer group. So there's tremendous operating margin leverage left. And we believe they'll catch the AI wave later in the year, early 25. Again, it's super early there, but we do believe that they're in a really good position as it relates to their solution in the front office. McKinsey commissioned a study and said that 3/4 of the AI use cases are in the front office. This should help Salesforce throughout the year.
So here's an important thing for everybody to understand about companies like Palantir making money from AI. companies like Snowflake even making money from AI-related products, and other companies in general. It's very important you understand this. It's a process. This is not like, okay, all of a sudden in 2024, all these companies are bringing in billions and billions of dollars from AI-related products. It doesn't work like that. There's a growth cycle. You're going from basically zero, right, to then $50 million of revenue, $100 million, $200 million. So the growth rate can be rapid, but the dollar amount is very small compared to the overall market capitalization of these companies, right? Think about, a Snowflake. A Snowflake's what, $50, $60 billion, maybe bigger than that market capitalization? Well, even if, let's say, Snowflake does an extra $200 million, which is a big number of AI-related revenue that wouldn't have been there prior, right? It's a small number for a company that size. Let's say Palantir, let's say they make an extra $200 million this year. That's a big number from AI-related stuff, right? Well, it's a very small number in comparison to their overall revenue, right? Now, as that scales 3 years out, 5 years out, 10 years out, then you're really talking. But it's from very small numbers at first, right? And so everybody's getting so excited about AI and the growth rates are going to be insane, but it's off such small numbers and base that it's not as exciting as it looks at first. And then 5 years from now, 10 years from now, everybody's going to be like, whoa, it actually happened. No different than the internet age, right? The internet age, you got to build out the infrastructure, get people to get computers, get on AOL, right? Remember Internet Explorer, what was it, 95, 98, all those sorts of products. Get that backbone built. So the companies like Cisco and Microsoft and AOL and those sorts of companies were the ones that really benefited early on. But then the companies like the Amazons and the Googles and those sorts of companies obviously made the huge money down the road. The companies like obviously Facebook and Meta and what they did, right? It's a process. And I just think that's important that everybody kind of understands that. And the one that's benefiting the most directly right now is obviously NVIDIA, and it will be AMD in the short term. Longer term, it will be the software related companies. And so in regards to Snowflake, I wouldn't put them in the casket. I think that company will be fine, but the valuation is not the most compelling in regards to Snowflake. The valuation's got to make a little more sense here, and then we can start talking in regards to Snowflake. All right, let's get into some inflation numbers, then we'll get into these other videos.
All morning, we are just a few seconds away from some new PCE inflation data, personal income and spending numbers, and initial jobless claims. It's the PCE number that's the biggie, though. That's the one the market's waiting for because that's the one the Fed watches so closely. Ahead of that, we've been watching the futures, and the Dow has been in the red all morning long, along with the other major averages. Dow right now down by 140, NASDAQ off by 44, the S&P off by 14. Rick Santelli is standing by at the CME in Chicago. Rick, take it away.
Yes, well, jobless claims, 215,000, higher than expected. 215,000 is the loftiest level going back to the beginning of February. On continuing claims, 1,905,000, and we finally crossed over 1.9 million. That's the highest read since the third week in November. Now the money numbers, personal income for January, up 1%, up 1%. And you know what's fascinating here? Last January, guess what? We started out up 1%. And last January, that was the highest level going all the way back to July of 21. So we're equaling January. This number, once again, could take you back to July of 21. That is a whopper of a spending jump, or income jump, on spending up 0.2, exactly as expected. Real spending goes negative when adjusted for inflation. That's down 0.1%, and down 0.1% equals what we had in August of last year. To find a lower number, you have to go to March of 2023. Now, let's get into it. The deflator, personal consumption deflator, month over month, up 0.3%, exactly as expected. In the rearview mirror, 0.2 becomes 0.1. Now, on the 310 side, that's the highest level since September of last year, something to pay attention to. Now, let's go back to the deflator, but this time the core, okay? And let's go year over year on the deflator, and that's going to be up 2.4%, exactly as expected. 2.6 in the rearview mirror, so making very good progress. This is the lowest level since February of 21. Now, month over month, core deflator up 0.4%, exactly as expected. And 0.4%, though, follows up 0.1%. So up 0.4% is the warmest number, going all the way back to January of last year. If you round it to half, if you round it to 0.36 up to 4%, that would be February of last year, because we take these things out a couple of digits. And finally, year-over-year core deflator, in my opinion, one of the more important numbers, 2.8. Last, what we expected, 2.9 last time, so we've made progress. Now, here's something interesting. This is my favorite calculation. This is now the 12th consecutive month that this has moved lower than the previous month, and that is indeed a very good thing, of course. Now, 2.8% is good, but consider this. Pre-COVID in March of 2020, this was 1.5%, just to give some context. Now, what have yields done? They've dropped precipitously here from basically 430 all the way down to 427. No, I'm being a bit facetious. We've dropped 3 basis points, but it is something to consider why we've dropped 3 basis points. And I think the real spending numbers being on the weak side might have contributed to that. We see that the pre-opening equities, the Dow Jones, has indeed moved up. And that's something to pay attention to here as well. It's getting close to, at least on the future side, positive territory. Now, I know that was a lot, Becky, but we want to take it step by step because these numbers are that important.
Yeah, so, I mean, everything's going kind of the way you'd want to see it. I'll just put it like that for now. It doesn't mean it's going to stay like that 6 months. The bottom line is there's still inflation in the system. It is obviously at a much lesser extent than we've seen it at, right? Real wages are getting in a pretty good place, which is very exciting for this year at least. And so, you know, if you look at the trueflation numbers, we're under 2% CPI right now. So I think everything's going the way we want it to go. Let's just put it like that. Okay. Celsius CEO, let's hear what he has to say.
Fourth quarter earnings this morning, beating street estimates, reporting revenue of $347 million. It's up 95% year over year. And this thing has been on fire. John Fiedley is here, Celsius' CEO. Good morning to you, John. Nice to see you. As I said, this is a beverage company that has just, I mean, you guys have just been, it's been a wild thing to see. How quickly can you continue to grow at this pace?
They're the elf on a shelf of drinks.
Yeah, it's exciting. It's exciting. How quickly we can go. There's huge opportunity for us in the category. We're celebrating today the first time in company history we broke $1 billion in revenue for a year, $1.3 billion in revenue. We're truly a $1 billion company and over $1 billion brand. So it's exciting. There's a ton of runway. The energy category is one of the fastest growing categories in food and beverage. And we are positioned for today's health-minded consumer. We're at 11.5 share in the category right now. We're one of the fastest growing drivers in both dollars and units. So we see a huge runway ahead.
So when you think about the brand of Celsius, do you see it as an energy drink only brand?
So before we go further here, I used to own Monster back in the day when it's called Hanson's Natural Beverage. And here's what I can tell you guys about these sorts of companies in this particular drink space, okay? I can tell you this. These companies can become immensely profitable over time. One, these products are very addictive. And the reason they're very addictive is because they have a lot of caffeine. Caffeine's very addictive, right? So naturally, you know, if somebody's used to more and more caffeine, their body is going to crave more and more caffeine. So yeah, it's pretty good when you're in the caffeine sort of business, right? So that benefits a company like Celsius massively. And then on top of that, these drinks are incredibly cheap to make. And they're usually able to sell these drinks for $1 or $2 to stores, depending upon the size, right? And I could tell you the actual drink product is, I mean, most of the time it's maybe 5 cents to 8 cents of the actual product that goes in the can. Many times actually the can is more expensive than the actual drink that's inside of the can, believe it or not, which is incredible to think about, right? And then one of the other big costs you have is distribution costs. But since these products do not have to be refrigerated, you know, overall you can transport it on you know, just a regular semi, which is pretty nice. So there's always a great business model, phenomenal business model. And then the question is, does Celsius's valuation make sense? Buying it up here, that's the big question.
You've tried to carve it out in this space of being fit and for fitness folks, if you will. How far can you extend it beyond drinks, if you would?
Well, that's the unlock and the opportunity here. You know, we started off in the gyms and health clubs. Really, we marketed the product in the early days as a pre-workout. We gained more awareness, especially with the growth in fitness. It became a fitness
and a pre-workout usually jacks you up with crazy amounts of caffeine.
Brand. And with our partnership with Pepsi, which we just celebrated a 1-year anniversary, they've expanded us into broader distribution. So we see a huge opportunity. We just went into Jersey Mike's as well, and our great flavors. I'm drinking an Oasis 5. We have a kiwi guava with some great, really refreshing flavors. We just launched a Cosmic Vibe this year, which is a really refreshing fruit punch. So we're seeing Celsius paired with meals, like at Jersey Mike's. We just went into Dunkin' Donuts as well, over 3,000. So we see the big category for Celsius even bigger than the energy category. And we also have a fizz-free line we just expanded in 2024. We're excited about that.
You do have the partnership with Pepsi. I think there was a question for a long time, and I don't know if the question's been put to bed, whether this is a company that remains independent, meaning yours remains independent long term, or gets swallowed up and owned by a larger drink maker. How do you think about that?
Yeah, I mean, we have a great team here. Our team's working hard, one of the best in the business. We actually just won Supplier of the Year at 7-Eleven. We're breaking records each and every day. The foreseeable future is to be number one in the energy category, and that's what we're working on. We're publicly traded, so we're for sale every day of the week, I guess, if you look at it.
The other question I would have, which is more of a consumer sort of news you can use question, which is, I think some people have sort of obviously fallen in love with energy drinks. There's a lot of other people who I think are still scared of energy drinks because they think, oh my goodness, is my heart going to go faster? There are questions about, if you drink too much of this stuff, what it does to your kidneys or your liver. And I know you guys have tried to address some of these things publicly, but how do you confront those issues?
Well, I think when you look, that's what's unique about Celsius. I mean, when you look at our formula and our ingredients, we have over 2.8 grams of vitamins, of green tea, ginger, biotin. So when you look at some of the formula ingredients compared to some of the competitors that are out there, we're much better positioned. One thing that's interesting is we're contributing to the growth of the category. So a lot of new consumers coming into the category for the first time are really trying Celsius and enjoying it. One thing we hear is no crash, no jitters on the product from a lot of our customers versus some of the other products that are out there. You get jittery on them, and there's some other complaints and negativity on it. So we hear that hands down on our product. We are a better for you energy drink and really align with today's health-minded consumer looking to live a better, active lifestyle and accomplish their goals.
When you sit around on a Monday morning, if you were to put up a whiteboard and draw out who you think your competitor set is, who are you looking at? I mean, is coffee on the list? I assume Red Bull's on the list, and Monster, and I don't know. We can go down the list, but how do you think about that?
Oh, yeah. We're hyper paranoid, always thinking about the list. Our Monday morning ritual is very intense as a group here and a leadership team within the organization. Our competitors, we just came into the number 3 energy drink and growing rapidly. So it's going to be Red Bull, Monster, and then Celsius. So we're looking at a 3-team race here as we enter into 24 and beyond. So we're really excited. We're number 1 in the energy category on Amazon. We do extremely well in other platforms and other regions of the country. So it's really an exciting time. We do see coffee as a competitor as well, especially some of the cold offerings. We have a non-carb line, and we have a green peach mango green tea, which is really phenomenal and differentiated in the energy category. So we really see this going beyond energy.
So question is, could I ever buy Celsius stock personally? Okay, I'll say this. I could buy that stock. The valuation have to make sense, though. So maybe in the future, maybe the growth rates kind of disappoint a little bit. Maybe that gets everybody jittery, no pun intended, and scared in regards to stock, and maybe I start a position in that one. But I haven't been as enthused at kind of the current valuation of that. When I first started buying Hanson's Natural Beverage back in the day, when I was working, bought that stock when I was, just had started working at Walgreens. That was like, 2010, 2011. Walgreens had, into 2012, Walgreens had gone through a little bit of Hanson's Natural Beverage, which became Monster, their stock had gone through a little bit of a tough time period. So that could always happen to Celsius. Let's imagine their growth rate went way down. Obviously, the stock would get hammered because people would be like, oh my gosh, what happened to the growth in regards to Celsius? Maybe that's an opportunity there. So, but like I said, those business models are freaking phenomenal. They're very addictive products. And like I said, the product that actually goes in it is very, very cheap. You actually spend a lot of your money on marketing related stuff. Next one up here, Apple needs to do something big, and Rivian might be the answer. What?
Munster and Gerber, Kawasaki president and CEO Ross Gerber. Gene, you say you're surprised, but I wonder why. Whoever thought that an Apple car was a good idea in the first place?
Well, I think Apple thought it was a good idea, and I think that they've got a history of redefining, reimagining product categories that were getting off the ground. And so the amount that they're investing, by my measure, was about $1 billion per year, most of that coming over the past 3 or 4 years. And Tim Cook said famously in 2017 that autonomous vehicles are the mother of all AI projects. And so if you listened and watched what they're doing, they wanted to do this. This was a goal. And of course, they've now shifted direction. So that's what surprised me. I had put the odds at this at 50-50 that this would come out, 50% chance. I'm famously wrong for predicting Apple Television that got killed in 2017. And that 2017 episode reminded me, because Apple is working on something doesn't mean that it will see the light of day. And now we add the Apple Car to that.
So Apple, I think according to my math here, they were spending around $1 billion supposedly a year on this project. So based upon my math of kind of what Apple likely makes profit per phone, that would mean they likely need to sell 2 million to 3 million phones to pay for this project overall in regards to profits.
Too hard on yourself. Apple TV does exist, not the physical TV, but of course the box. So we'll give you a pass on that one, Gene. Ross, is this, I mean, listen, Apple could have probably owned Tesla 5 to 10 years ago. Maybe they still could take.
I'll tell you why Apple never made the TV, because Gene Munster for years, he did think that Apple was going to make an actual TV, like, I don't know, 65, 75, 85 inch TV. Listen. Here's the deal with Apple, okay? Apple likes to make small products. This is their specialty. Those little iPhones and little iPads that can go in a little box, and distribution cost is extremely cheap, and you can ship them all over the place. It's a piece of cake. All of a sudden, if you're talking about selling 65, 75, 85-inch TVs, oh my gosh, what a nightmare. Oh my gosh, like, you know, that is no fun, and that's a very, very low margin business, as we do know, the TV game, right? And so to then get people to try to pay up for that would be a big challenge. So I wouldn't be surprised if Apple had ambitions to do a big TV over time. The biggest product that Apple really likes to do is obviously their biggest lineup of Macs, right? But they can sell those at price points of several $1,000s because people can justify it in their heads in terms of, you know, what they're getting for a product like that. A TV, very hard to sell for several $1,000s. It just is. Like, you know, people have gotten very accustomed to $500 to $1,000 for a big screen TV that's connected and all those sorts of things.
That's at it. Who knows? What's your take?
Well, I was with Gene with the Apple TV, and, you know, I still can't believe they didn't release the TV, but I knew they were never going to do a car. You know, being an early Tesla investor and knowing their mode and knowing where they were at, and I had done many interviews back as far as 2015, talking about Apple taking a stake in Tesla. And when Tesla was in trouble in 2018 and needed money, supposedly there was a conversation between the two that Tim doesn't remember. But that lack of memory probably cost him hundreds of billions of dollars for Apple shareholders if he would have taken a stake in Tesla at the time. And just the same, we see a similar opportunity for Apple if they want to be in this business by taking a stake in Rivian. But they don't want to be in this business, and they've made a clear commitment to Vision Pro, and moving this team over to AI is the smartest thing they can do. So this is a good move for Apple.
Do you think, and I'll go back.
Here's the thing, though. You can't just like move teams like that and say, okay, you guys were working on a car, now go work on AI. You can do that, but it's just like people have different skill sets and different talent levels. And some people are very good at this sort of engineering. Some people are much better at this and that. And so, you know, I just think it's a false assumption to be able to assume somebody that's working over here can go, hey, go work on this. You can do that. It's just like you're not going to get the best of the best to really do that.
Ross, right? We're going to just have a little fun. It's Tuesday, worst night of the week. Let's have some fun. Any chance Apple at $2.8 trillion in market cap could try to buy Tesla at $700 billion in market cap? Or is that completely insane?
That is insane.
Well, not with this FTC. I mean, this FTC won't even let two bad grocery stores merge, let alone something as dominant as that. So, we got to wait till something changes there. But in theory, I think the bigger issue is that Tim Cook and Elon Musk are like oil and water, and they would never work together ever.
That's okay? True. 100%.
Literally ever. So it would have to be one or the other in charge and the other not being involved if that was ever going to happen.
No, we know the federal government loves Elon Musk, so you never know, Ross. Maybe they could just take a pass. Please, it's too.
What Elon's going to do?
The show just started. It's too early for the sarcasm.
It's Tuesday.
Exactly. Gene Munster. Apple.
It's ridiculous. Here's the deal. Okay, would Elon Musk sell Tesla to Apple? The answer is absolutely not. Like, the thing is, Elon Musk believes Tesla could be the biggest company in the world, right? So for him to even sell it to anybody for any number just doesn't make sense. Even if he sold it at 1.2 trillion to Apple or whoever, it just doesn't make any logical sense. Like, no.
Cars are hard. I mean, phones, the thing with your eyeballs that they're doing now. Okay, those are hard. Cars are a different animal. If you're an Apple shareholder, many of our viewers and listeners are, should they be happy about this news?
I think they should be disappointed. And part of it is that Apple's a tech company, and tech companies by definition need to grow. And that's the $400 billion question that they have. That's their revenue this year. And to grow a top line, they haven't grown their top line for the last 6 quarters. And to grow the business, you got to get into some big markets. Vision Pro has some potential, but that was the kind of the shiny opportunity related to the car. This could, if they get 10% of the automotive market, that would grow their top line by 60%. We can set aside the earnings question, but I understand that most investors thought that this was a low probability, and that is reflected in how the stock traded today. But ultimately, I'm disappointed. I think Apple could have done something really special when it comes to automotive.
Well, I'm sorry to interrupt, Gene, but to the point I just made with Ross, the question rather.
The issue is Apple, outside of, what product has Apple come out with that's really a Tim Cook related product, right? And not Johnny Ive, Steve Jobs. The only product so far has been the Apple Vision Pro. Everything else was either worked on by Steve Jobs or Johnny Ive. And so, that's the trouble. You only got Vision Pro out there, and people are like, I don't even know if that's going to be a hit. Yeah, no, it looks like, if anything, it's definitely not a hit. And so that's tough.
There's a chance, you're saying there's a chance, that Apple is abandoning its own effort because maybe it does want to take a pass. Maybe not at Tesla, which is massive, but maybe at a Rivian, maybe at a Lucid, right? Instead of build, just buy.
I think that makes sense. I think the Rivian piece that lines up. I think by my last check, it's $10-12 billion market cap, and definitely more doable. And I think it does line up. Apple could do this, and I think that would get them into that bigger market. So I'm disappointed that this turn in events, and so I don't want to be predicting that they're going to ultimately do something like this. But I do think Apple needs to break into some new market. And dare I say the television? It still surprises me that they didn't do it. I don't want to go back to that conversation, but they need to do something big, and potentially Rivian would be just the answer to that.
Yeah. Amazon's a huge shareholder. I'm not sure they would really allow that. Can't wait to hear Jamie Dimon on the U.S. economy. No. I mean, the bottom line is the Vision Pro has potential. The problem is they screwed the product up. It's not a good product go to market. I've watched the videos on it. It's not an Apple grade product go to market. It's not a product that the moment you see it, like, oh my gosh, it's a freaking game changer. I can't wait to get my hands on this, like the iPhone was, like the iPad. And, many of these other products, obviously, Steve Jobs and Johnny Ive launched over time. If Jobs and Ive worked on that product, one, it would have been under $1,000 price point. Two, they wouldn't have had a flipping flapjack and battery pack. You got to keep with it. That's just ridiculous. Three, the fit would have been way better. Like, it would have looked way cooler. Like, everything about that product would have been immensely better than what they put out there in the marketplace. I can tell you that much. It would have been a product that people would have seen and been like, oh my gosh, I can't wait to get that, and I can't wait to buy it at that price point. Next one up here, JP Morgan CEO Jamie Dimon on the state of the U.S. economy.
For high yield and leveraged finance conference in Miami, you've got executives, deal makers, investors, all kind of coming together to talk about the financing environment. How would you characterize C-suite confidence levels now?
First of all, thrilled to be here. Thank you for doing this. This is our 29th conference. I've probably been to 20 of them since I became CEO of JP Morgan Chase. You know, look, you always got to look at markets that they change their mind pretty quickly. But right now, confidence is up. There's more M&A chatter. Equity markets open a little bit. Spreads are getting close to historical lows, which means there's a lot of money chasing high yield deals. So things are kind of open. Markets are high. People feel it. So far, so good.
That sounds to run somewhat counter to your more bearish views. I know you said in fourth quarter earnings that last month that inflation may be stickier, rates may be higher than the markets expect. Is that still your base case?
Okay, wait a minute. Wait just a flip and flapjack a moment. That's not necessarily a bearish view. That's a cautious view from the, arguably the most important man in all of finance in the world, right? That's just a cautious view. It's not bearish.
What's kind of fueling that more cautious tone right now?
Yeah, so the way I look, remember in 1972 you felt great too, and before any crash you felt great, and then so things change. So you got to look ahead. And I do think there are things out there which are kind of concerning. We've got an eye on, and why are we doing so well? A lot of it's fiscal spending, and fiscal spending has a multiplier too. 100%. So I just think it may not come down that quick, and people may be surprised. So when people talk about the market is kind of pricing a soft landing, that may very well happen. But the odds at 70 or 80%, I would give them half of that. That's all. 7
or 8 rate cuts?
No, 70 or 80% chance we'll have a soft landing. I give it half that. We may very well have one, but I think there was also a higher chance in the market things of rates being.
Whoa, okay, now wait a minute. Wait, just flip and flapjack a moment. Jamie Dimon just got bearish. I'll put it that way. No, he's talking about half that. Okay, half of 70 to 80% is 35 to 40%. So now he says there's a higher probability that we're not going to have a soft landing versus have a soft landing. So that right there, that's not a cautious statement. That is actually a bearish statement. I'll say that. So interesting. Very interesting commentary by Jamie Dimon there.
The other thing I think it's always a mistake to do is look at just the year. All these factors we talk about, QT, fiscal spending, deficits, the geopolitics, those things may play out over multiple years. But they will play out and they will have an effect. And we just don't know what they are. So I'm just, in my mind, I'm kind of cautious about everything.
You're hedging.
Yeah.
I want to ask you about commercial real estate. We've got nearly $1 trillion of commercial multifamily real estate debt that will mature this year. About half of that, about $1 trillion, $929 billion worth.
Yeah.
Half of that is owned by banks, mostly regional banks there. The rest is either securitized or due to non-bank lenders. We've seen higher levels of defaults in certain pockets of the market and a slump in property prices recently. Do you think that stress in commercial real estate will ultimately be the source of the next credit event?
First of all, put commercial in perspective with consumer. The consumer markets are far bigger. So what happened in 07 or 08, this isn't that kind of thing. And a lot of these owners of this can handle what you call stress. So in the banking system, I'm just going to focus this in office for a second because there's warehouse, there's data centers, there's hospitals, and some of that stuff is actually well done. But if you take just offices, first of all, they're worth less because of interest rates. When interest rates go up 300 basis points, whatever you own with their cash flow is worth 30% less. And so people, that's not a crisis, that's kind of a known thing. And then there's if you have a recession, yes, it'll get worse. If we don't have a recession, I think most people will be able to muddle through this, refinance, put more equity in. And of course, when you talk about defaults being higher, part of that's just a normalization process. They were so low for so long, so in all of credit, you're watching things go up, but they're not at a crisis level, they're just kind of going to normal. So yes, if rates go up and we have a recession, there will be real estate problems. And some banks will have a much bigger real estate problem than others.
So you think, as you kind of assess the landscape and regional banks, there'll be more of a whack-a-mole than a kind of domino effect?
As long as the economy stays like this, there'll be more of a whack-a-mole. There should be no domino effect. The problems you've seen were kind of idiosyncratic problems with Silicon Valley, First Republic, New York Community Bank, and a lot of these, it's very local. I mean, when you talk about real estate, I think when you say blanketed, if I call it an office and I have great leases in it, it's fully leased out, 20-year leases, that's completely different than a spec building. So you really got to dig deeper, and you know, we try to do that when we look at credit about where it is. It'll be pockets.
Are you concerned at all about just the migration of lending taking place in the non-bank financial sector? I mean, we're here at the Global High Yield and Leveraged Finance Conference. I know there are a lot of private credit managers here, but that's something that's caught the regulators' attention as well.
Well, finally, maybe wake them up a little bit. First of all, I don't mind competition. Some of these people who you call private credit are excellent. They know what they're doing. That doesn't mean they all do. And when you look at policy issues about private credit, first of all, we've been doing it a long time. Just keep in mind, like, we make loans, middle market loans. They came through with a bunch of stuff that made it simpler. Unitranche, actually more expensive. Unitranche, different covenants. You know, you could sign it quickly, no pricing. But there are other things, less transparency, less liquidity, no secondary markets, no research. So you got to look at the whole thing, what works and what doesn't work. It will sort through it. We'll be a competitor. I have no problem knowing that we're going to be a competitor. And a lot of smart people out there, you know, they've been on TV saying, you know, I said they're dancing in the street, but they agree with me this time. They say, absolutely, banks are being pushed out of a whole bunch of different businesses. And, you know, I always say, if that's what the regulators want, then do it. I'm completely fine with it. JP will do fine, but it should be done with the forethought, not accidentally. Like I said, there are some negatives. So I think if you have a major recession, you'll probably see some issues in private credit. Whether systemic, you know, not, I don't really think so, but it might be in ways we don't understand today.
Speaking of competition and regulation, last week we saw a major deal with Capital One, and it's...
Before we go further here, you know, it's very, very intelligent move by Jamie Dimon to be more cautious just in general, right? And the reason being is, imagine you actually get a recession. Imagine Jamie Dimon's been out there, you know, last year, this year, and he's, you know, everything's great. It's going to be booming economy, blah, blah, blah. Everybody would come down on him playing those clips. Oh, Jamie Dimon said it was going to be great, and look at, we had a crash and this and that, right? And make him look really bad. Obviously, then JP Morgan would have to let him go. It would be a poor look on his reputation, right? So it actually is a smarter move to be much more cautious and bearish from his angle. I'm just telling you guys, it's much more intelligent than being super bullish, and then the bearish situation plays out, and then you look like, you know, a little clownish, right?
To acquire Discover, the potential there is to reshape the credit card industry. The combination would create the largest card issuer in the U.S., surpassing JP Morgan Chase.
For now.
As measured for now. So if this deal is approved, does it create more competition for you?
I think companies should be allowed to do and innovate and grow and merge and try to challenge things. I think that's good. So I think it's a mistake to act like it's bad. It's good for competition. In fact, I think they should allow some of these smaller banks to merge. If that's how they think they can best compete with JP Morgan, you should let them. It may not work in every case, but you shouldn't predetermine that. You should let the market predetermine that. In this particular thing, there's the credit card business, which is they'll be bigger, more scale. They're very good at it. I mean, I have enormous respect for Richard Fairbanks and Cap One. And then there's the networks. There's the debit network and the credit network. The debit network, it may have an unfair advantage versus us. Of course I have a problem with that. You know, like, why should they be allowed to price debit different than we price debit just because of...
By the way, it would be fun if everybody walking in the background, like, had a little thing that goes above their head and it, like, says how much they make a year and, like, what their net worth is at one of these, like, big JP Morgan conferences. That would be quite entertaining.
I don't know what their plans are, really. You know, like I said, I have a lot of, whatever Richard does, I pay a lot of attention to do. Can they actually create another credit card network? I don't know. But, you know, my view is let them compete. Let them try. And if we think it's unfair, we'll complain about that. But I'm not worried about it, really. But we do track everything he does.
And on that regulatory bucket...
I always make a joke with Richard that the reason I have my job is because of him. Because Cap One is the one that kind of dissected the credit card business. Cap One started to beat the hell out of First USA. First USA, which had been bought by Bank One, collapsed, and it, you know, called into credibility of the management, and they hired me. So Richard is why I'm here.
It all goes full circle.
That's crazy. Crazy stories, right? All right, guys, appreciate you joining me. Hope you enjoyed today's video. Thanks so much for being here. Thank you for smashing that like button. Also, make sure you guys get that workshop below. How much money you need to quit your job, how much money you need to retire. Goes very in depth on that subject in general. I think a lot of you guys will get a lot of value. I've gotten some really good feedback in regards to that video. It's a video a lot of people have been wanting me to do for a while, and I said, let's do it as a workshop. So free to access that, pin comment down there. Much love and have a great day.